Good evening, everybody. Those of you who have been to Money Life Foundation events would certainly know about Mr. Kapoor, and those of you who have read Money Life magazine also would know. It's our pleasure, as Sucheta said, to welcome Mr. Pankaj Kapoor, and we thank him graciously and generously for agreeing to come for the third session of Money Life Foundation event, and I'm sure he'll come for many more of these. We certainly benefit enormously from his association. Mr. Kapoor is a founder and managing director of a company called Liasis for Us Real Estate Rating and Research in Mumbai, and has about 14 years of experience in independent real estate research. He has developed a real estate sensitivity index, which offers the movement of real estate industry based on sales, inventory price, and various other parameters across different regions, Mumbai, National Capital Region, Pune, Hyderabad, Chennai, and Bangalore. Mr. Kapoor has also developed a structured database on real estate market in India and a unique valuation and forecasting model. I would now request Mr. Kapoor to come.
The presentation highlights about some key changes which is going to take place now in the industry, how the industry is going to unfold. I'm not going to talk about that what should have been done, what has not happened, because this is a one industry where every irregularity gets regularized. So you just can't really have, and I never expected this strong bill to come. You know, whatever way it has come, I had never expected. So the other day when I was talking to Mr. Dalal, and we were talking about this, and I said that I'm very surprised. I never expected this will happen. But if it has happened for the good for the consumer. And the very fact of this is that the disclosures which it brings in, and that transparency is going to really bring a lot of efficiencies to the markets. Yeah, you know, I take you through the presentations, like regulatory bill, what may change. I say may change because I still don't know whether it's going to get passed or not. Still I have a doubt. The presentation will cover the likely changes in the real estate market due to the regulatory bill, current state of the market, the liquidity conditions, will prices undergo the corrections. That's a very important factor, like, you know, all the problems are related to the affordability, all the problems related to, you know, I'm seeing that the nature under which the regularities and irregularities are happening in the market, they are, most of the time, they are economic driven. You know, we introduced a lot of capital into an industry which did not require capital. On the pretext of the affordable housing, we created investor market, unoccupied homes. And when the investors with those big aspirations for the returns came in, they put the consumers away. And what we got at the end of it is only increasing slums. So the economy has, and the policy which were introduced in the market 5 to 6 years back, post 2005, especially FDI policy and other things. So that has created so much of inefficiencies in the market. If you look at post that only, we have seen all the scams taking place. Post that, we are seeing that how the land prices escalated. Post that, we have seen that how you know, the real estate prices have gone up. And post that only, we have seen the slums increasing. So eventually, in the hindsight, when I see that, you know, it's a very poetic situations, and what is happening today, there is more than one reasons to it. So there are political pressures to the government who is put it onto the brinks to withstand their own credibility. So they needed to do something. And that is where they had to come up with this regulatory. But nevertheless, there are other pressures also, and they were the economic driven. I just want to show you some very interesting slides is that, you know, the main highlight of this regulatory bill, which I see, is the disclosure. And disclosures means the developer cannot say and hide. Most important thing is the rationale of their super built up loading. You know, he has to disclose the area statement, he has to disclose the carpet area, TDR, FSI, utility area, common area. And that is one thing which is most common. Apart from that, you know, the title related things, the building wise time schedules, what he is going to construct, time schedules for connecting the projects with the municipal water supply, fixtures and fittings. So all those things which used to be written in the brochure saying that, I am giving you dream home, and at the end of it, subject to change. I think that may not take place. So he has to commit what he is going to deliver. Now, in light to that, there's going to be huge amount of transparency. And he has to mention about the possession dates. So he will not come and say that you buy today and I'm going to give a delivery after 2 years, because he himself knows that he still hasn't got the permissions for the environmental clearances. A lot of things which we have seen that the project got launched in 2010 and the environmental clearances for those projects is coming in 2011 and 2012. The pre-sales has taken place, all those things may not really happen. So no number of units to be developed, parking space for layout, phase-wise plans, etc. So the mandatory disclosures of the area and its distributions would perhaps make the loading insignificant, because consumer definitely is going to be aware and he's going to ask for, for 700 square feet of a carpet area, you cannot charge 1600 square feet. And in that light, what all we had been thinking and advocating for a very long period of time, saying that industry should really move to the carpet area level, we should be away from this super built up. I think that era is going to come, and we are seeing very early signs of it. I'm at least knowing at least 3 to 4 developers who have started practicing this. And why I'm saying that, there's another 2 reasons for it. One is the advent of this regulatory bill, and second is there is no sales in the market. So they can't reduce the price because they have sold at the higher price to the existing investors. So what they are selling at the lump sum rate. So what they say that this is a flat for 2 crore rupees and take it, and this comes with the parking, this comes with the floor rise, this is what is the carpet area you are going to get. So what it is indicating, to some extent the developer have realized and they are moving to that particular area. So this will be a new era, and I think so we are going to see that the property going to be sold as per the carpet area basis. How loading, and why I said that there was very interesting reasons for it. If you look at the how loading was exploited in the market, and I was just going through how the projection which used to be, or canopy which used to be 1.2 meter went up to 3.5 meters, and that is how the overall usable area developer got. That's a free of FSI area which he started selling to the consumer. So if you look at it, this is a 3-bedroom hall kitchens area descriptions mentioned, which is in the western suburbs, and it shows that the BMC carpet was 897, plus there was a other flower deck and other things was mentioned, and then the usable area became 1000, and then the sellable area became 1560. So altogether the loading turned out to be 74, and this is very reasonable in the sense of it. All the projects which got launched in 2009, post 2009, virtually have this kind of a loading available in the market, although the developer may say 45%, but it is at, which it was in the range of 74%. But then the new DCR came, and new DCR regularized. But they regularized keeping the developer's interest intact. Developers should not lose any area even though it was illegitimate. So you look at that very simple example. That's like, it's a very well goal seek. Why 2.35? Why not 2.5? Why not 2.2? Why only 2.35? If you look at in that set of that, like, at that just data analysis, there was earlier days with the 500 square feet. If I say that is by plot size, the FSI is 2. My FSI index is 2. FSI comes 1000. Additional non-FSI area, which developer was not loading at that point in time, was 0. Sellable area loading used to be 45%. Sellable area used to be 1450. Actual carpet, and the plot to sellable area ratio used to be 3. And then the gray area came in when the 500 became 1000 and the additional 17% loaded on that. Then, and over and above, 45 further loaded, and that's where the sellable area became 1697. Altogether loading on the carpet became 70% on an average. But very interesting thing is just the way the gold seek has taken place in the new DCR, which is 2.35%. If you look at the loading, the plot to sellable area ratio has maintained the same level. So, what it means that, what you have been what you have been doing, I'm not taking it away. And I think this is how the reality has gone through. So, and this is where the politicians and developer nexus has helped it to have the things or to have the laws made in their own favors. I just want to see that, the 250 square meter of a plot virtually covers every single projects across Maharashtra. We cover Mumbai and Pune on quarterly basis. So if you look at it, almost 99.5% of the supply of all the markets are covered through that. So in the purview, the whole of the supply, so the entire gamut of the market is under the purview. There are few more important points which is going to be, because of this DCR, is the no pre-sales if it is being enacted, because what it shows that no transactions in the marketing without the registrations. So in that case, that what was generally happening is that the environmental clearances which is coming in 2011, for which the property was already launched in 2008, may not really take place if it is mandatorily followed. Sampaji can give much better light to this, how much it is practiced, but nevertheless the laws are there which can forbid the developers. Another thing is the retained flat, the 10% of the flat to be retained and by the developer till OC is obtained. Now in this light, this shows that lock capital, you can't sell those particular flats. Mandatory registration after receiving more than 20% of the value of the flat. I was quite naive when I thought this is going to put end to the investors. And when I spoke to Sampaji, he said that, Pankaj, it was there in the MOFA also, so don't be very happy. But, if it is followed properly, it will really dissuades the investor, especially those trading investors, and realty cannot afford those trading markets. But there is another side of it that probably the black money will increase because of this particular thing. Refund for failing to give a possessions within the stipulated time. Delays may go away, but the project will officially take 6 years, which today developer says 3 years. But I think so now they themselves will prescribed in that. They said that we can't complete. They would be definitely, they will keep the buffer in that sense. So, and I tell you, I am analyzing data, and we'll share that data with you also. Most of the projects today are taking 5 to 6 years time. Although developer says that he's going to give you delivery in 2 years or 3 years time, but there is always delays. In nutshells, the developer's requirement of the capital is going to increase. And there is no capital in the market right now. So there is going to be a major problem after the enactment of this particular bill. And let's see how the market is poised. So this graph shows you the market's movements with various times, and shows that the state of the inventory and sales, and as well as if you look at in this particular graph, you will find that this is basically a ratio of monthly sales to the inventory, and which is very nice ratio, which represents the health of the market, and it's clearly indicating that the most of the times the efficient market maintains 8 months to 11 months of inventory. But right now we are in the range of 40 to 37. Last month there was a little bit of improvement because of that. The month's inventory has gone down. But if you look at the way the prices have gone up, that prices are indicating they're highly unproductive prices. They are not selling, so my inventories are piling up, my sales are very low. Year-on-year performances, if I see the market, is that although the prices have gone up, we have seen then on the previous slides that post corrections, and since they're like for prime 5,356 price as on September 09 has gone up to 11,178, which is more almost the double the price, like within 2 years' time. But despite that, the prices are going up, the industries, but these prices are highly unproductive. They're just not making enough sales. So not only in terms of the square feet, but also in terms of the revenue, the market is going down. So if you look at my 2009 post corrections, the market sold the maximum 63 million square feet in Mumbai. It came down to virtually half in 2011, 2012. And we just can't say that there's no supply. Developer may always come forward and say there's where is the supply. There's a huge inventory. The launches are still coming. Although there have been a talk about there's no approvals. But the period in which developers were going in for the strikes, they were close to 150 new launches in MMR regions. So the supply has not really reached to a halt. There are new launches coming one after another. So you look at it, but with that kind of inventory, my off-tick of the inventory is very low. And that's also representing the market is shrinking gradually. And this is indicated by a very nice curve, which is a price and the velocity curve. Velocity is very important thing, is which people miss to look into. Every price has its own productivity. Very simple example is that mill land sales. And the property which is now being officially purchased by another developer, DLF land, when it got sold at that point in time, it just put the bar of the new prices and new scales of the realty. But from 2005 till 2011 or 2012, the project could not be created, and the basic reason was that the price at which the property was sold was highly unproductive. If you're purchasing a property of 10,000 rupees FSI cost under that prevailing DCR, you can't really produce with a decent IRR a project less than 25,000 rupees per square feet. And 25,000 rupees per square feet does not sell as much as 8,000 or 9,000 square feet rate sells. So in that sense, the price was way too high. And that's another reason, is that this high mill land sales has influenced the market to bring out with lot of controversial FSIs. Have we ever thought about why the parking FSI came into being? It just came in to increase the productivity of those land which were sold at the unproductive prices. Because because of that we could increase the FSI. But something is like that. Despite that, because a lot of capital got involved at that point in time, and the capital comes with its own interest on it. So if you calculate the 702 crore at which the property got sold at that point in time, and with the private equity's return of 21%, you would find that it couldn't be sold less than 3,000 crore rupees, and that is what is the price. And despite there has been an additional FSI granted that. So the price is a highly unproductive, not only from the land rate point of view, even from the selling rate point of view. It's not selling. And this, because of this, like how unproductive these prices are, you can see that this is my market is generating 38% less money than it requires to deliver the projects in time. When I'm launching project, I'm making commitment into the market that I'm going to give you a ready product on stipulated date of, but the prices are so high it's not generating enough sales, which is not translating into enough cash flows, and that's a basic reason. If you look at it, we have close to 38% deficits. These are my monthly receipts. this is like the stock which I am selling. If I am multiplying it with the construction progress of those building, I know that how much of the receipts is coming, as well as what is his commitment to deliver, and there is a shortfall. And that's a basic reason the delays are there. Delays, approval may be one reason, but the biggest reasons of the delays are the cash flows. We don't have enough money to continue with the construction. We're not generating enough sales. And that's a very, very simple sign of the market, which represents like, Pune market, until 2 quarters or 3 quarters before, it was a rising curve because the prices maintain its own efficiencies, and developers were resorting to the sales proceed to meet their construction cash flows. So they needed to continue constructing because their disbursements of the money from the banks is also linked to the construction progress. And that is where it was a very progressive market in that sense. The prices were good. It has kept the balance, which is not the case in Mumbai. If you look at the all along, there are projects close to 40% of the projects which are, or 45% of projects which are more than 12 months delay, which is seeing as on date, and it may keep on going further. Do we have cash? And this is very important aspects, is not only from the point of view of cash being generated from the sales, but do we have alternative money available? And this is the money which has created a major problem for real estates. And because of that, we have seen all these price rises. Now we are seeing this, even this money is drying out. So there's not much private equity capital coming into the market. So there is, if you look at it, it is showing a retarding trend. Credit growth of the sector is also on the decline. So if you look at ones which used to be close to 29%, in as of March 12 has come down to 12%. So even in the funding from the banking other sectors, which is also drying out. And even with the money flow which happened in past, what is very important to see that my NPA growth has gone up. And this is something which I can't understand from the point of view, why did we allow the restructuring at that point in time in 2008? And today we are reaping it's seeing because the NPA has gone up. And this is all because at this point of time when the NPA was at this particular level, we had seen the corrections in the realty prices, and we have seen the sales coming back. And in the market, when we introduce 2 lakh crore or 1 lakh crore rupees worth of the restructuring, what we allowed it to push the problem further in the future, and today's situation is just widening. Construction pace in MMR has been sliding. So all along. So what you are seeing that the state is not just in a good shape. So why I'm talking all these things, just to give you a glimpse about that the liquidity condition is not good. Inventory is huge. Sales are not enough. We have a huge commitment to meet, and we are not having enough money. And that's basic reason is probably we are seeing, there's one more important point which we are also want to say that, for which I started and begin the things, is that how unpatriotic our policy has been, especially in regards to the FDI in the real estates and the private equity capital in the real estate sectors. So much money in the sectors on the pretext of creating affordable housing were brought in. It has only created unaffordability in the housing. Because residential real estate market, you did not, as per the FDI law, RBI knew that they did not allow the money to go into the land. Having said that, all the money has just gone in for land, and the land prices and the land is speculation. And the sector which is where the sales takes place before the construction starts, and from the sales proceeds all the construction takes place. If you pour in so much of money, it always increases the speculation, and that's what has happened. The prices have gone up. Developers don't want to share their share of profits. Investors want their own interest. So at the end of it, they go and ask the consumer, okay, give me higher prices because I needed to take care of my investors also. But problem is that consumer can give you the money as much he can afford. And most of the times these prices have outplaced the consumers. And since there was no consumer, no sales in the market, eventually I'm today seeing that most of this money is losing their own interest. Like the exits which is today happening is happening at a low margin. We are seeing one after another problems coming in. That is one side of the market, and that is from the real estate point of view. But what is important is these prices have really put my country into a degrowth curve. And why it has happened? Because when you sell the country growth, you sell infrastructure and real estate and say that so much of growth is going to take place in this market. But what you have not done is, looked into, is that this money has created speculations and the asset bubble where only land prices have gone up. There is no production which has taken place. If you look at my construction pace is coming down, if my construction pace is coming down, that means the lesser demand for cement, lesser demand for the steel, and that will have a huge impact on the overall economy. And we did, probably 1.5 years or 2 years back, we came up with the data. We were showing that my incremental construction is coming down. And probably this is going to have a negative impact on overall economy. But no one listened at that point in time. And I tell you, even today the scenario is more or less the same. And today that's basic reason that from 8.5% now we are at the 6.5%, whether we are going to hold it or not. Contrarian to the other market, like every other market has really, used this money. And we can say that there is an investment which has taken place in China also. But one thing good happened in the China is the money which came in just went in for productions. And because of that, at least the utility took place, the production happens, and because of that, the global economic market may be the same. But there are other countries which are able to manage and maintain their own growth level, where we are probably finding it difficult to maintain our domestic numbers, domestic demand numbers. So that's basic reason is that GDP growth is down. Question comes is, will prices come down? This is my purchasing power parities and affordability and a price index. If you take is the interest adjusted income and the inflation adjusted prices, my gap has been increasing. And this gap always shows that the way the prices are going up, people are not able to afford it. And today's the gap is so very high that we assume that even after even if the interest rates come down to the 9% level, market still has to undergo 32% correction to reach to the parities, to bring out the requisite offtake which can create economic balance for the real estate. But will it happen? And looks very difficult. And the basic reason, this capital will always act as a buffer. And we are seeing very early signs of it, where we know that the market seemingly moving into a kind of a hibernations, where investors will be frustrated with the hope that there would be recovery. The major problem in the market is that these are the unproductive prices. We have no problems of the demand in Bombay or any other markets. Only thing is that at least I've got 15 to 20 friends of us who have been looking at purchasing a property for a very long time, but we are not able to afford it. And where they say that go and afford it, those are uninhabitable locations. So there are affordability concerns at each and every place, and that is what is going to take take a long time for undergoing corrections. And I am seeing that the correction is likely to be a combination of time and price corrections. And the basic reason is the employed capital will act as a buffer. The black money will act as a buffer. Having said that, we are seeing the sign that the market is going to show the sign of the shifts. The rate is going to really shift the carpet area first, which may invoke a perception the market may go up, but actually it is at the same level, and then later on it may come down. This is a very interesting curve also. I wanted to show that, like, despite market has gone up, has the demand shift has taken place. We keep talking about salary increase and bonus and the cost and inflations and all those kind of things. Very interesting aspects. This is too much of data in this small graph. I'll just explain you. There are price trends from the left to the right. There are ranges of the prices starting from 1500 going up to 1 lakh rupees. What you see there is the range of 4000 to 4500 where the market has maintained the peak. So it was in 2008, it was in 2009, it was 2010, it was 2011. So you look at that shift has not really happened till now. The majority of the sales is happening only at that particular level. But what has happened over a period of time over here and all those things, you see there was not much of the demand, but the supply. The back thing shows the supply curve as on date. If you look at this, because of the higher non-FSI area, usable area, a lot of developer went into creating luxury housing. And this is very high-end sections, and huge supply came into that. So there is major concerns into the market, and regulatory bill is going to bring a lot of transformations, and this transformation is a change, and there would be a lot of inertia in accepting these changes, and that's a basic reason you would see that the market may not attain efficiency so soon. That's what I wanted to say. Thank you.